Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 17th of July. I'm Daniel Lam, your host for the podcast. Last week, we spoke about how Chinese equities were in a quote-unquote embarrassed kind of situation, i.e. it is being pulled in various directions by different forces, and it has been range trading at a very cheap level. Well, the price action for the rest of last week suggests that the market was extremely hungry for good news. The Hang Seng Index rebounded very strongly on the back of positive news, such as the extension of some of the property stimulus, comment by Premier Li Qiang that it is necessary to establish and improve regular communication mechanism with internet platformed enterprises, and the sharp fall in US dollar following the lower than expected US CPI figure. So after this strong weekly rebound, one would very naturally ask, is this the time to chase Hong Kong China equities? Well, technically, the Hang Seng Index tried to test the upper end of the downward channel that has been in place since January this year, but it failed to break on the upside on Friday. In fact, it formed a quote-unquote reversed hammer pattern, i.e. selling off from the highs and closing at the day low, which is usually a signal for pullback after a strong week last week. However, the volume of the sell-off from the top on Friday was not so substantial. So that means that if there were to be some pullback, it could be limited. And we do not expect the Hang Seng Index to be retesting the 18,000 level. The macro environment is relatively favorable. For example, the dollar has been weakening as inflation numbers eases in the US, which in turn alleviated the pressure on CNY. And also there has been a cooler environment on the geopolitical front after Yellen's visit. Most importantly, stimulus may be coming over the next 2 to 4 weeks, potentially at the Politburo meeting at the end of July. And this may include the following: further loosening in housing policies, especially in Tier 1 cities, fiscal stimulus, such as possibly approving an additional local government special bond quota of 500 billion CNY this year, if land sales revenue were to be below budget. Infrastructure investment growth from policy bank lending, and encouraging consumption and business climate of the private sector. Thus, we believe investors may consider adding to Hong Kong China equities, as there could be some potential upside in the near term. A reasonable level to add would be the 50% mark of the move over the last 10 days, i.e. 18,900, which is essentially the mid-mark between the intraday lows at 18,280 and the intraday high at 19,534 over the last 10 days. We believe consumer sectors such as communication services and consumer discretionary are the sectors in focus. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.